Welcome back to the channel, where we break down the often complex world of finance and investing into simple, straightforward advice that anyone can follow. Today, we're diving into The Little Book of Common Sense Investing by John C Bogle. This book is a modern classic, filled with timeless wisdom about how to invest wisely and build long-term wealth. John Bogle, the founder of Vanguard and creator of the first index fund, transformed the world of investing with his simple, no-nonsense approach. If you're tired of complicated investment strategies or are wondering how to make the most of your money, then this video is for you. Bogle's philosophy is rooted in common sense. Invest in low-cost index funds. Let your money grow over time and avoid the temptation to chase short-term market trends. Whether you're a beginner looking to start investing or someone who's been at it for years but wants to simplify their approach, this book offers practical insights for everyone. Bogle's message is clear. Investing doesn't need to be complicated. In fact, the simpler your strategy, the better your chances of success. Investing wisely is about understanding the big picture and not getting lost in the noise of daily market movements. With that in mind, we're going to explore some of the key principles from the Little Book of Common Sense Investing and show you how these ideas can help you make smarter personal decisions. Ready to discover the common sense approach to investing? Let's dive in. At the core of Bogle's philosophy is a revolutionary idea: invest in low-cost index funds. Now, you might be wondering, what exactly is an index fund and why is it so powerful? Let's start with the basics. An index fund is a type of mutual fund designed to track the performance of a specific market index. One of the most popular indexes is the S&P 500, which includes 500 of the largest companies in the U.S. economy. When you invest in an index fund that tracks the S&P 500, you're essentially buying a small piece of all 500 companies in the index. Instead of trying to pick the next Apple or Amazon, you're betting on the long-term growth of the entire market. Why is this important? Because over time, the stock market tends to grow. Historically, the S&P 500 has delivered an average annual return of about 7% to 10% when adjusted for inflation. This means that by simply investing in an index fund that tracks the market, you're likely to see your money grow over the long term. You don't have to worry about picking the right stocks, guessing market trends, or timing your buys and sells perfectly. Bogle believed that, for most investors, this simple strategy is far more effective than trying to outsmart the market. Why don't most professional fund managers outperform the market consistently? It comes down to two things: market unpredictability and the cost of active management. Let's look at these two factors. First, markets are unpredictable. Even the best investors can't consistently predict which stocks will rise or fall. There's simply too much uncertainty. What might look like a great stock today could crash tomorrow due to an unexpected event. Second, actively managed funds charge higher fees because you're paying for the expertise of stock pickers and analysts. Unfortunately, most of these funds fail to beat the market, especially after accounting for these higher fees. Now, let's consider the alternative, an index fund. Instead of trying to pick stocks or time the market, you invest in a fund that mirrors the market. You're essentially spreading your risk across hundreds or even thousands of companies. So, even if one company in the index performs poorly, it won't drag down your entire portfolio. You've diversified your investments, reducing your exposure to any single stock's volatility. Think of it like owning a small piece of every major business in the market. If the economy grows, the value of the businesses in the index grows too, and so does your investment. It's a passive approach that relies on the market's natural growth over time. Historically, this strategy has worked because the stock market, despite its ups and downs, has a long-term upward trajectory. Index investing also offers a powerful advantage: simplicity. You're not constantly monitoring the market, reacting to every headline, or stressing about whether to buy or sell. You set up your investment, sit back, and let it grow. This peace of mind is something that even experienced investors value because it frees you from the emotional roller coaster of daily stock market fluctuations. The real beauty of index investing is that you don't need to be an expert to succeed. You're not relying on anyone's predictions or hot tips. You're just following the tried and true path of the market's long-term growth. Over time, this can be a powerful wealth-building tool for anyone, whether you're investing for retirement, a child's education, or another personal goal. Now that we understand why index funds are such a smart investment, let's move on to one of Bogle's most important principles, the cost matters hypothesis. It might sound technical, but it's actually very straightforward. The idea is this: the less you pay in investment fees, the more of your money is working for you in the market. This concept is simple but incredibly powerful. High investment fees can eat into your returns, and over time, they can make a huge difference in how much wealth you accumulate. Imagine that your investment is like a snowball rolling downhill. As it rolls, it picks up more snow and gets bigger. Just like your money should grow as it earns returns. But what if there was a toll every time the snowball rolled? Over time, the snowball would grow much more slowly. High fees work the same way. They're like a toll on your investment that slows down its growth. Even small fees, when compounded over many years, can have a significant impact on the size of your investment. Let's break it down with a simple example. Say you invest $10,000 in a fund that charges a 1% fee. At first, 1% might not seem like a lot, but over time, that small fee adds up. After 30 years, that 1% fee could cost you tens of thousands of dollars in lost returns. Now, compare that to an index fund that charges a fee of 0.05%. Over the same period, you'd keep a lot more of your returns simply because you're paying less in fees. This is why Bogle was such a strong advocate for low-cost index funds. They typically have much lower fees than actively managed funds because they don't require teams of analysts trying to pick stocks. Instead, they simply mirror the performance of the market. And the lower the fees, the more of your money stays invested and compounds over time. Keep in mind, fees aren't always obvious. They can be buried in the fine print of investment statements. But just because you don't see them doesn't mean they're not there. That's why it's so important to pay attention to the costs of your investments. The less you pay in fees, the more money you have working for you. Now let's talk about one of the most powerful forces in investing: compounding. If you take away just one concept from this video, let it be this: compounding is your best friend when it comes to growing wealth. Compounding is when your investment earnings generate their own earnings, leading to exponential growth over time. It's often referred to as the snowball effect because your investment starts small, but as it grows, it picks up more returns, which then generate even more returns. Let's break down how this works. Imagine you invest $10,000 and earn a 7% return in the first year. At the end of the year, you'll have $10,700. Now, in the second year, you're not just earning a 7% return on the original $10,000, you're also earning 7% on the $700 you made in the second year, first year. By year 3, you're earning on both the original investment and the returns from the first 2 years. This cycle continues, and over time, your money starts to grow at an accelerating rate. The earlier you start investing, the more time your money has to compound, and the more dramatic the growth. That's why Bogle emphasizes starting as early as possible. Even if you can only invest a small amount at first, time is your greatest ally. The longer your money has to grow, the more powerful the effects of compounding become. Compounding is why patience is so crucial in investing. You might not see huge returns in the first few years, but as time goes on, the growth accelerates. It's like planting a tree. At first, the growth is slow, but once the roots take hold, the tree starts producing fruit year after year. The same is true with your investments. If you stay patient and leave your money invested, compounding will work its magic. To really see the power of compounding, consider this. If you invest $10,000 today at a 7% return and leave it alone for 30 years, that investment will grow to over $76,000. That's the power of compounding. And the longer you leave your money invested, the more it grows, which is why starting early is so important. Bogle's message is clear. The sooner you start, the better. Time is your biggest asset when it comes to compounding. Even if you start with small amounts, those early investments will pay off big in the long run. Another critical lesson from Bogle's book is this: don't try to time the market. Market timing is the practice of trying to buy stocks when prices are low and sell them when prices are high. It sounds simple, but in reality, it's incredibly difficult to do consistently. Even professional investors struggle to time the market effectively. The truth is, no one can predict the market's short-term movements with certainty. Think of the stock market like the weather. One day it's sunny, and the next day it's stormy. Just like it's hard to predict the weather months in advance, it's nearly impossible to predict what the stock market will do on any given day. If you try to time the market, you might miss out on some of the market's best days, which can have a huge impact on your long-term returns. Let's look at some real-world data to illustrate this. Historically, some of the stock market's biggest gains have occurred during just a few key days. If you're out of the market on those days because you're trying to time when to buy or sell, you could miss out on a significant portion of the market's overall returns. In fact, studies have shown that missing just the best 10 days of market performance in a given period can drastically reduce your overall returns. Bogle's advice is simple. Instead of trying to guess the market's ups and downs, stay invested for the long haul. Think of your investment strategy like running a marathon. You don't win by sprinting and stopping. You win by keeping a steady pace and staying the course. By staying invested and not trying to time the market, you give yourself the best chance to capture the market's long-term growth. Trying to time the market can lead to emotional decisions. Buying when prices are high because of excitement, or selling when prices are low out of fear. These emotional decisions often hurt investors in the long run. That's why Bogle encourages a set-it-and-forget-it approach. Stick to your long-term investment strategy, ignore the daily noise, and focus on your long-term goals. Bogle's final piece of advice is perhaps the most important. Stay the course. Investing is a long-term game, and there will be times when the market dips or even crashes. During these times, it's easy to panic and want to sell everything, but that's usually the worst thing you can do. Market volatility is a natural part of investing, and those who stay invested through the tough times are often rewarded when the market rebounds. Think of your investment journey like sailing across the ocean. There will be storms and rough waters along the way, but if you keep your ship steady and stay on course, you'll eventually reach your destination. The key is not to jump ship at the first sign of trouble. In fact, history shows that those who stay invested during market downturns tend to benefit the most when the market recovers. During the 2008 financial crisis, for example, many people panicked and sold their investments when the market dropped. However, those who stayed the course and kept their money in the market saw significant gains in the years that followed as the market rebounded. The lesson here is simple. Don't let short-term market movements distract you from your long-term goals. Bogle's advice is timeless. Stay the course. Don't get swept up in market volatility or daily fluctuations. Stick to your long-term investment plan, trust in the process, and give your investments the time they need to grow. This approach takes patience and discipline, but it's the key to long-term personal success. In investing, patience truly pays off. By resisting the urge to react to short-term market changes and staying focused on your long-term goals, you increase your chances of reaching your personal destination. Markets will go up and down, but history shows that they tend to recover and grow over time. Staying the course through the ups and downs is what separates successful investors from the rest. So, what's the common sense approach to investing according to John Bogle? It's simple. Invest in low-cost index funds, minimize your costs, let your investments compound over time, Don't try to time the market, and most importantly, stay the course. Building wealth isn't about getting rich quick. It's about growing your money steadily and securely over the long term. Bogle's common sense principles have helped millions of people achieve personal success, and they can help you too. The beauty of this approach is its simplicity. By following these straightforward principles, you can set yourself on the path to personal independence. If you found this video helpful, give it a thumbs up, share it with your friends, and don't forget to subscribe to our channel for more practical, no-nonsense personal advice. Thanks for watching, and we'll see you next time.